Welcome, everyone. Thank you for joining FHFA's listening session on the Homeownership Gap, Affordability and Sustainability. My name is James Wiley, and I am the head of the Office of Fair Lending Oversight here at FHFA. The Office of Fair Lending Oversight provides fair lending analysis for FHFA's policymaking and conducts supervisory oversight of the enterprises. I'll be introducing today's speakers and moderating the time. Thank you all for participating. Public feedback on this critical question confronting the country is very important to FHFA. I want to make sure everyone knows that this session is being recorded. You will be able to review a video and transcript later on FHFA's website. There's a list of discussion questions in the agenda, or you may address the topic more generally. Before we get into guest speakers, it is my pleasure to introduce Acting Director Sandra Thompson, who will be providing opening remarks for today's session. On June 23rd, President Biden appointed Sandra Thompson to be Acting Director of the FHFA. Director Thompson has a distinguished career in public service and has been a champion on issues of fair lending and affordable housing. For just a few of many examples of that commitment, as Deputy Director of Housing Mission and Goals at FHFA, she oversaw affordable housing and mission activities and sponsored the creation of the Office of Fair Lending Oversight. At the FDIC, she led the agency's examination and enforcement program for safety and soundness and consumer protection at the height of the financial crisis. Director Thompson.
Thank you, James. I am honored by the President's appointment, and I'm really looking forward to leading FHFA as we continue to carry out our agency's important mission. Since I first joined FHFA in 2013, I've had the pleasure to work for 4 different directors and acting directors, each built on the accomplishments of their predecessors, and I'm looking forward to continuing that tradition. Certainly in the past few years, FHFA has made great strides in strengthening our agency and our regulated entities. We will continue to build on this foundation, which includes this series of listening sessions. Let me thank all our participants for joining today's virtual listening session on closing the gap to sustainable homeownership. As you may know, June is National Homeownership Month, but as we know all too well, unfortunately, access to homeownership is not evenly distributed across our nation. Today, there's a widespread lack of affordable housing and access to credit, problems that are especially concentrated in communities of color. FHFA plays a vital role in both promoting access to mortgage credit nationwide and protecting the safety and soundness of the housing finance system. We do this through our supervision of Fannie Mae, Freddie Mac, and the Federal Home Loan Bank system. Throughout my career as a financial regulator, I've said that safety and soundness and access to credit are not mutually exclusive and shouldn't even be thought of that way. Broad, fair access and stability for financial institutions work as pillars of the nation's housing finance system. Indeed, sustainable access to credit requires sustainable lending standards. I served as the FDIC's head of supervision throughout the most recent crisis, and I witnessed firsthand the consequences of irresponsible lending when hundreds of banks across the country were closed and a record number of homes went into foreclosure. I saw how the borrowers who received unsustainable loans and suspect loan products were devastated in the downturn, and Black and Latino communities were hit especially hard. Years of progress in closing the racial homeownership and wealth gaps were erased as a result. In fact, today, the Black-white home ownership gap is wider than it was in the 1960s, when lending discrimination that was based on race was still legal. As a regulator, I know what expanding access to credit looks like, and I also know what irresponsible lending looks like. Irresponsible lending is not an expansion of access to credit. FHFA will continue to protect the financial system and our nation's borrowers from irresponsible business practices at our regulated entities and, by extension, their business partners. Today is an opportunity for us to hear from you about how to sustainably close the homeownership gap. Your feedback will help FHFA ensure that our regulated entities equitably fulfill their mission and responsibilities. And our exchange of information will not be limited to formal listening sessions like these. We are always interested in hearing from stakeholders, experts, and people with on-the-ground perspective to share. I look forward to continuing this conversation, and I encourage you to continue giving us candid feedback. Thank you again for joining today's listening session. I can now turn over the program to Kevin Sheehan from the Office of the General Counsel. Kevin?
Thank you, Director Thompson. As Director Thompson said, my name is Kevin Sheehan. I'm a lawyer at FHFA. And as James mentioned earlier, we are recording this session. FHFA will prepare a transcript of the meeting, including your names and the organizations you represent. And we're going to post the recording and the transcript on FHFA's website and our YouTube channel, along with any documents or materials that our presenters use today. So we've invited you to meet with us today in order to obtain your input on the topic of closing the gap to sustainable home ownership. At this time, FHFA will not discuss the status or timing of any potential rulemaking. If FHFA does decide to engage in a rulemaking on any matters discussed at this meeting, please be aware that this meeting does not take the place of the public comment process that FHFA would use for rulemaking. You would need to submit your comments, if any, in accordance with the submission instructions in whatever rulemaking document FHFA would issue. And if you do submit a comment letter in response to a future FHFA rulemaking, FHFA would include your letter in the public rulemaking comments docket. And FHFA may also summarize the feedback gathered at today's meeting in that future rulemaking document if we determine that a summary would be useful to explain the basis of that rulemaking. Also, please remember that nothing said in this meeting should be construed as binding on or a final decision by the FHFA director or FHFA staff. Any questions we may have are focused on understanding your views and do not indicate a position of FHFA staff or the agency. And finally, I know we have a great lineup of speakers, but also the time that we've allowed for each is shorter than usual for our listening sessions because we wanted to hear from as many people as possible. So while I'm sure that each speaker has much more to share on this important topic than they can in the time slots that we have, I would ask that everyone please help James keep us on schedule and respect his efforts as moderator because we really do want to hear from everyone and we want everyone to have the same opportunity to present. And so with that, I will turn it back to James Wiley to guide us through the session.
Thank you, Director Thompson and Mr. Sheehan. I'm going to quickly cover some logistics. As part of the Zoom call, speakers have the ability to mute and unmute themselves. So please mute yourself when you are not speaking. The order of the speakers is in the agenda, and I will introduce each speaker and note who will be up next after that. I do note that we have some speakers that are not in the session right now, and we are hoping they will join. So I'm going to do my best to keep track of that. But if you are on the call and you think I have skipped you, please keep me honest, and we will make sure to work you back in. We have a number of speakers today, and we want to be sure everyone gets a chance to speak in the allotted time. So please stick to the agenda of 5 minutes per speaker. In order to keep us on track, I may break in verbally to note that you have 1 minute or 30 seconds remaining. We'll also have a 5-minute break halfway through the session. With that, our first speaker is Ed Pinto of the American Enterprise Institute, and then Amanda Nunnick and Pam Perry from Freddie Mac will be next. Ed?
Thank you, and thank you, Director Thompson and FHFA for this opportunity. If you could bring up this So you're using the slide decks? Yes. I'll go through these pretty quickly, focus on a few slides. The first question that was asked is, what are the major factors that contribute to the racial homeownership gap? There are a number. Go to the next slide, please. Unsustainable stressed mortgage default rates at origination are a key factor. They relate to the traditional items, borrower household income being lower, resulting in higher debt to income ratios, also lending with excessively high debt to income ratios, lower borrower and intergenerational wealth, which tends to result in higher loan to value ratios and lower borrower credit scores. Additionally, more loans with just a single adult of record also historically correlates to roughly double the default rate of loans compared to those with two adults. Supply constraints and higher costs caused by excessive land use laws is another major factor. While those laws and NIMBYism have constrained supply and needlessly raised the median cost of housing, federal affordable housing policies had a major compounding impact due to the almost exclusive reliance on high-risk lending, that is, lending with stressed mortgage default rates above 14. The racial homeownership gap is largely due to these systemic housing policy failures that continue to promote demand while supply languages, which have a disparate impact on minority and low-income families. If you're going to skip to slide 9, there's a series of slides before that that go through and substantiate each of those. Question 4, how should sustainable homeownership be defined and measured? As previously noted, the stressed mortgage default rate provides a powerful tool for measuring relative future risk of loans at origination. There's data in here that shows how well that did just in indicating the level of relative level defaults during the recent pandemic. The foundation of sustainable home ownership is sustainable lending. This means loans with stress default rates of less than 14. The FHFA, the GSEs have a history of making loans well in excess of 14. They've been cut back some in recent years, but they're still making loans well in excess of 14%. If MDRs had been capped at 14% at origination, we estimate that 26% of above 14% delinquencies nationwide would have been eliminated, and 19% of total delinquencies would have been eliminated during the recent pandemic. The result would have been material reduction in defaults in low-income neighborhoods and sustainable wealth generation, more sustainable wealth generation. Please skip to slide 12. Are the enterprise affordable housing products, Home Possible and Home Ready, effective in promoting sustainable home ownership? If not, what changes should be made? The short answer is no. The mission products go back to the early 1990s. Home Possible, Home Ready came in later post the financial crisis. The GSEs began purchasing conventional loans in 1971, yet home ownership rates today stands at 65.6, virtually unchanged from 64.4 in 1971. The GSEs, along with FHA, have made first-time buyer loans with high mortgage default rates commonplace. Risk-layered features of high LTV, high debt ratios, and low credit scores, combined with the 30-year term, are at the core of the problem. Next slide, please. Based on census and ACS data, we can see that the rate of homeownership for low-income households actually declined. Next slide, please. High leverage lending merely permits one borrower to pit against another buyer for scarce goods, specifically low-priced tier entry-level homes. This puts upward pressure on home prices, does not expand access, and is dangerous. And that's what Home Possible and Home Ready and the GSE's predecessor programs continue to do. Instead, the GSEs, along with FHA and other federal affordable housing policies, have led to over 10 million foreclosures and other forced dispositions over the last 20 years. Next question.
We've got about 30 seconds left.
The solution is rather than having loans with MDRs above 14%, the 20-year loan should be used to bring those levels of defaults down. And that would be a major solution. Next slide, please. If you go to the multifamily slide, which is basically says the multifamily program isn't needed by Fannie and Freddie. The private sector can handle that demand quite handily. Thank you.
Thank you, Ed. So we'll go to Amanda and Pam at Freddie Mac next. And then I see that Katrina Jones has joined from Fannie Mae. So Katrina, you'll be up after them. And I've also seen a question in the chat about availability of materials. The materials will be posted along with the transcript on the website. Amanda and Pam, over to you.
Thank you, James, and thank you to FHFA for the opportunity to speak today. I'm Pam Perry, and I lead, quite privileged to lead Freddie Mac's single family equity team, and my colleague, Amanda Nunning, leads multifamily's equity team. It's imperative for Freddie Mac to amplify its commitment to its mission and to be intentional in its approach to eliminating disparities in homeownership in our country. Amanda?
Thanks, Pam. So while this session today is dedicated to the gap in homeownership, I would like to share one area where our work in multifamily intersects with what we're talking about today and the work that my colleagues are doing in single family, and even aligns with some of the stats that Edward just shared. And that's primarily in credit building and financial capability. So our conversations with credit bureaus have indicated that for the 44 million renters in the United States, less than 10% of them benefit from the on-time payments of their rent being reported to the bureaus. That's likely an individual's largest monthly payment is going unnoticed unless there is an issue. And so what you see is average credit scores in the low 600s for renters versus 700s for homeowners. And that delta gets even bigger when you factor in race. So we have early efforts underway supporting credit building for renters, and we intend to marry that with other tenant advancement and homeowner and potential homeowner advancement efforts, such as credit building, such as Credit Smart. That is our proprietary financial capability program that we're relaunching this weekend, actually. So stay tuned, and we're happy to share those details with you. With that, I'm going to turn it back over to you, Pam.
Thank you, Amanda. Freddie Mac senior management has charged me in the single family space with digging into the root causes of racial inequity in housing and proposing innovative solutions that advance homeownership and wealth in underserved communities. The attendees on this call are all too familiar with the data and research just showing how pervasive the homeownership gap is for communities of color and the criticality that we address it now. In single family, we're bringing a high level of focus to addressing gaps in Black homeownership and wealth because this is the community with the greatest need rooted in long-term historical discrimination. However, as we tackle these challenges, we hope to bring solutions to bear that will serve communities of color more broadly, including the growing Latinx community. My team is looking at new ways to approach these challenges in partnership with many others who will be speaking this afternoon. Initially, we're focusing on 4 key areas where we think Freddie Mac serves the greatest chance of driving impact. The first is barriers to loan qualification. We understand the need to look at issues such as loan qualification criteria, lack of down payment assistance, lack of rental payment data, as Amanda was referring to. And we're drilling into these issues as we address homeownership gaps. Despite the challenges, however, there are numerous untapped opportunities for Black homeownership. Our research shows that as of January 2021, there are 11 million Black millennials, representing 22% of the Black population. We also know that there are 3.4 million Black Americans under the age of 45 who have the credit characteristics today to qualify for a mortgage, yet they are not currently mortgage holders. These mortgage-ready borrowers represent a pressing opportunity for us all. How do we help eradicate barriers to future homeownership for these millions of Black Americans? One key area where Amanda's and my work overlaps is the preparation of future borrowers. It's imperative that we expand our community outreach and financial capability programs by meeting borrowers where they are. We'll continue to foster industry partnerships with real estate professionals, loan officers, state and local FHFAs, and housing counseling organizations that serve as a conduit to serving current and future minority homeowners. We are laser focused as well on addressing appraisal gaps. This area of focus was born out of the media coverage last year of anecdotal disparities and our conversations with community leaders and others in the industry. Freddie Mac is collaborating with the industry to investigate appraisal bias and gaps and their root causes. We are leveraging our portal of appraisal data with a goal of sharing our research and working with the industry to drive solutions to address any identified root causes. And last but not least, we're focused on access to housing supply. The US suffers from a severe housing shortage. It is estimated that 2.5 million additional housing units will be needed annually to make up the shortage. We are focused on creating solutions that support neighborhood revitalization, enabling homeowner preservation, expanding access to credit, and creating and preserving affordable housing inventory. I'm thrilled to have the opportunity to change the paradigm in addressing housing equity with partnership with all of you. Thank you, James.
Thank you, Pam and Amanda. Katrina Jones from Fannie Mae, are you with us?
I am. Can you hear me?
Yes. So
Great.
Katrina, you're up next. And then after that will be Kristen Zieglin from the Homeownership Alliance. Go ahead.
Super.
Katrina.
Thank you for having me. My name is Katrina Jones. I spearhead our racial equity strategy and impact work for Fannie Mae. And I'm super thrilled to be here with all of you to learn and to listen. You heard a good number of facts from Ed on how we got here. In addition to how we got here from a homeownership gap perspective, I'd also offer that lack of affordable housing supply, additional alternatives to assessing creditworthiness, misinformation from consumers on what it takes to buy or rent a home, from savings, down payments, monthly debt obligations, are also contributors to the homeownership gap. These are challenges that are particularly problematic because homeowners, for many Black homeowners, this is the way that their families achieve short and long-term financial success. It allows them to send their kids to school, improve their homes, age in place, pay off debts. Fannie Mae appreciates and acknowledges the importance of homeownership, especially in Black families. And we're committed to doing all that we can do to support a housing finance system that facilitates equitable and sustainable access to homeownership and quality affordable renting housing across America. So based on the feedback we've heard from many of you on this call today and other industry stakeholders, we're building the foundation for closing the homeownership gap across 4 key areas to get us started. The first is around early education, and that's really where we're going to spearhead efforts to drive early education around all aspects of financial literacy, creating a pipeline of future homeowners. For renters, we recently launched our Rent Smarter application on the App Store, providing one-stop shop for those renters. For homeowners, we recently launched Your Own Story, which is available on knowyouroptions.com. Think of this as part of an educational continuum that aims to educate consumers on credit, personal finance, all the aspects of owning a home well before they're on their path to a first home. Second is enabling equitable access to housing. We recently launched the sponsor-initiated affordable program in multifamily. It encourages apartment property owners to set aside at least 20% of their units to rent for affordable people making less than 80% of the area median's income. In single family, we're reevaluating alternative ways to leverage different data sources and our desktop underwriting system, allowing access to mortgage financing for more first-time home buyers. Thirdly, it's providing home stabilization, resourcing, and support. It's not enough just to get you in your home. We need to keep you there as well. And through our free, customized counseling services provided through our disaster relief network, it's been helping families stay in their homes suffering from financial hardships due to COVID or other natural disasters. We are also reevaluating our appraisal process on a number of fronts to ensure that the approach to appraising homes and the related valuation, it's fair in communities of color and for people of color. And in this space of sustainable home ownership, we're also ensuring that lower income borrowers have additional refinance options through our recently launched Refi Now program. It's aiming to lower monthly mortgage payments, creating greater affordability and sustainability. And finally, in our 4 areas of focus, we've established programs that aims to provide greater diversity and inclusion across the mortgage industry. The first is our Appraiser Diversity Initiative, which identifies and recruits diverse entrants to the appraiser profession. Our Future Housing Leaders Program, it's connecting more than 50 single-family and multifamily employers with a diverse pipeline of students for paid summer internships, and for many, their first-time entry-level job. These are just examples of some of the foundational efforts that we started. But before I close, let me share with you the wealth creation that happened for our family. When my grandfather, as a young man, he traveled here from Caroline County to DC, settled in, started a family. He could not read, he could not write. However, he understood the value of owning a home. He signed a mortgage note with his mark, which back then was his ex. That land in my family's home is how we've continued to carry out our American dream of home ownership and wealth creation for my next generation. My call to action to all of you, we have much more to do over the upcoming years. It will take a village of lenders, industry partners, and our regulator and others who are willing to lean in over the upcoming years. Share your perspectives in forums like this. Help us think differently in terms of how we reach, teach, and educate Black consumers, existing homeowners, and the mortgage industry stakeholders in how to make equitable access to affordable rental housing and sustainable homeownership a reality, not a dream for Black families, one mortgage and rental unit at a time. I'll pass it back to you.
Thank you, Katrina. Up next, we have Kristen Zieglin from the Homeownership Alliance. And then after that, we'll go to Michael Lofton from HomeWise. Kristen? Kristen, you're on mute.
Thank you for holding this listening session on closing the gap to sustainable homeownership to examine the racial homeownership gap and explore what more Fannie Mae and Freddie Mac can do to close this gap. I'm Kristen Zieglin, Vice President of Policy and Partnerships at the National Community Stabilization Trust, and I manage the Homeownership Alliance, a coalition of nonprofit developers and lenders that advocate for more resources and better policies to increase affordable homeownership opportunities for American families. The Homeownership Alliance members comprise some of the leading nonprofit mission-focused homeownership practitioners from across the country. These organizations prepare families to become successful homeowners and finance, renovate, and develop affordable homes that are assets for communities and the families that live in them. My written statement includes a summary of research on the causes of the racial homeownership gap, but in the interest of time, I will keep my remarks focused on what we might do to improve enterprise performance and raise the Black homeownership rate. This is essentially the same as it was in 1968 before passage of the Fair Housing Act. I have three suggestions about this challenge. Racial disparities in wealth in the US are the outcome of generations of differential treatment, and the solutions will have to address all of the different barriers that account for wide gaps in homeownership rates. The enterprises need to approach the homeownership gap with the seriousness that a problem that is this pervasive, pernicious, and persistent deserves. The enterprises need high-performing partners to create a pipeline of mortgage-ready buyers, suitable starter homes, and sustainable mortgages. FHFA should direct the enterprises to find partners like Homeownership Alliance members in target markets to ramp up the production of affordable homeownership with a focus on loaning to Black families. You'll be hearing from Mike Lofton of HomeWise about his systematic approach to working with families, and David Dworkin of NHC will describe the 7-point plan of the Black Homeownership Collaborative. Both demonstrate the sort of systems thinking that is needed to solve the homeownership gap. FHFA should build on this listening session and invite Homeownership Alliance members, Black Homeownership Collaborative members, and others to a session with the enterprises with the goal of creating a plan to increase the Black homeownership rate. The focus of the conversation should be on creating a system to narrow the homeownership gaps and greatly improve enterprise performance on the affordable housing goals, duty to serve, and the percentage of loans to Black borrowers that the enterprises buy, which in the latest reporting was 3.06% for Fannie Mae and 3.28% for Freddie Mac. While it is true that the enterprises are the end of the pipeline of the home buying process, they need to be held to the standard of being good partners to the nonprofits and CDFIs that are doing the hard work of helping families prepare to be successful homeowners. One member of the Homeownership Alliance points out, we see 10 new clients before we have a client ready to buy a home within 3 months. It takes time and lots of education, debt and credit repair, and helping families to save. It takes our average buyer 8 to 10 months of counseling to be ready. Fannie and Freddie need to compensate nonprofit partners for the education, counseling, real estate services, construction services, and loan servicing work they do to reach non-traditional borrowers. In addition to FHFA using its convening power to foster partnerships to tackle the racial homeownership gap, FHA should also reconsider its own policies that make it harder to close the gap. If the enterprises were allowed to make equity investments in community development financial institutions, this could help these mission-driven lenders expand and serve more Black borrowers. Finally, FHFA should rethink the January 2021 agreement with the Treasury Department on the senior preferred stock purchase agreements that place restrictions on what types of loans that the enterprises can buy. They limit the GSE's purchase of high-risk single-family loans to 6% of their purchase money mortgages and 3% of their refinancing mortgages. It's not clear that these limits are necessary or advisable. The mortgage refinance boom last year generated record profits, yet what the enterprises and the rest of the real estate finance system have been doing to date has resulted in a racial homeownership gap that is as large as it was in 1968. FHFA should require a systematic and thoughtful approach to closing the homeownership gap by harnessing the work of mission-driven housing developers and lenders to the scale and financial sophistication of the enterprise. Thank you.
Thank you, Kristen. Next up, we have Michael Lofton from HomeWise, and then we'll hear from Matt Douglas at the Housing Policy Council. Michael?
I just lost my thing. Where did it go? I'm sorry.
No problem.
Okay. Thank you. So it's widely understood that America's racial wealth gap is largely driven by its racial homeownership gap. What is not as well understood is how improving access to homeownership is also vital to increasing housing affordability for low-income households and for people of color. I explore in depth how homeownership is affordable housing in my Urban Institute paper, which you can find on the Urban Institute website. The big power of homeownership in driving housing affordability happens over time. This is because the biggest portion of a homeowner's housing expense is held constant. Assuming the homeowner has a 30-year fixed rate mortgage, the principal and interest portion of the house payment stays the same for 30 years. Only the property tax and insurance portions of the house payment are subject to inflation. On the other hand, there is no such thing as a 30-year lease. 100% of rent is subject to inflation. The net effect of all this is that on average, the typical homeowner pays 10 percentage points less of their income on housing than does the typical renter. Of course, this is true, many would say, because homeowners typically have higher incomes than do renters. But if you control for income, the 10 percentage point difference holds true. Low-income renters, those with annual incomes of less than $50,000, typically pay 34% of their income on housing. Low-income homeowners pay only 24%. Very low-income renters with incomes less than $20,000 pay almost half their income on housing, 48%, while homeowners pay 38%. Let me clarify the significance of this 10 percentage points difference. For example, take a household with an income of $40,000. The typical renter with this income pays 34% of their income on housing, or about $1,133 a month. In contrast, the typical owner with this income pays only $800. This is a difference of $332 each and every month. The affordability advantage of homeownership is also true across race and ethnicity. While white homeowners pay less of their income on housing than do Black and Latino homeowners, Black and Latino homeowners pay less than all renters, including white renters. Homeownership can help America close the wealth gap and increase housing affordability. These goals are not oppositional, they are complementary. We can accomplish both housing affordability and wealth creation if we focus on the right things. So how do we take advantage of the homeownership opportunity? There are many barriers that can obstruct the path to homeownership. An effective strategy will need to be comprehensive enough to address these multiple obstacles. Addressing only one of the barriers without addressing the others that get in the way will just result in yet another frustrated want-to-be homebuyer. Help with a down payment will not help the buyer if they can't qualify for a mortgage because of credit or debt issues. A buyer who qualifies for a good mortgage will have a difficult time buying a home if no mortgage lender or real estate agent is willing to help her because the purchase price, the loan amount, and the corresponding commissions are too low to get anyone's attention. A strategy that is effective at increasing access to home ownership must be holistic and include a service delivery system that is able to address multiple issues simultaneously. There is no simple technical fix. It is not just a mortgage product issue. It is a systems problem that can only be addressed by improving the homebuyer delivery system so that it is adept at addressing multiple barriers. We need to invest in building an alternative homeownership delivery system that can help those who have been underserved by the current system. Importantly, this alternative system must also help people access homeownership in a way that will help them be successful homeowners over the long term. Getting people into a home of their own is no help if the buyers are not set up for long-term success. Fortunately, we already have some core components of this delivery system, which I think exists in CDFIs and other nonprofit organizations such as HomeWise, that are focused on serving underserved populations in a responsible way. But we need to build and expand the capacity of this fledgling network. Fannie and Freddie should invest in CDFIs, should invite them to become seller servicers, should provide incentives for them to make small dollar mortgages that take advantage of existing affordable homes, and support other strategies that I don't have time to get into here. Building a more robust homeownership delivery system will take time and resources, and we will not get to scale overnight. But as the old adage says, the best time to plant a tree was 20 years ago. The second best time is now. So let's do it now. Thank you.
Thank you, Michael. Matt, you're up, and on deck we have Leslie Gooch from the Manufactured Housing Institute. Go ahead, Matt.
Thanks, James. Before I dive in, I'd like to just take a quick moment to congratulate Acting Director Thompson, who I know has the passion and skill to lead FHFA on this critical topic. I'm Matt Douglas, the Vice President of Mortgage Policy at the Housing Policy Council. We're a trade association comprised of 32 member companies who are among the nation's leading mortgage originators, servicers, insurers, and data and settlement service providers. Our members are completely united in their desire to close the racial homeownership gap. We simply cannot significantly expand the ability of individuals, families, and communities of color to build wealth in this country until we close the gap. And while this is an enormous challenge, the good news is that the recent consensus and energy around the issue by all major stakeholders gives us a real opportunity to begin addressing this challenge. The other good news is that we as an association see some things that FHFA can take and do at its sole discretion without the need for legislation, regulatory changes, or even getting the enterprises to do something that would meaningfully address this racial homeownership gap. Namely, and the theme of everything I'm going to be saying is FHFA should use the tremendous amount of data it has to provide significantly more information to the public through its research operations, but as well as in the reports to Congress. And that's the first thing I want to highlight is the easiest and most significant thing we think that FHFA can do is to provide more data on race and ethnicity in its reports to Congress. FHFA already compiles and puts out a ton of information through the annual housing report and annual report to Congress. However, really neither of these reports provide significant details about the racial composition of the product lines. Without this type of view into the dispersion of the GSE products across racial and ethnic groups and a way to measure what progress is or is not being made, stakeholders like us have trouble determining what is working, what's not working, and we're really just looking at aggregate numbers like what the enterprises report in their annual housing and activities report, which are not always reported consistently, just aren't as helpful as they could be. You as conservator and regulator should provide easily accessible and comparable data for each enterprise along each of their major product lines, from Home Possible and Home Ready to the overall single family book of business, to the enterprise housing goals, to duty to serve. The report should also provide trended data so that stakeholders can assess whether progress is being made relative to the overall enterprise market share. The enterprises should also provide assessment of whether the enterprises are taking sufficient actions to address the homeownership gap, much the way as in the recent annual report to Congress did in the diversity and inclusion section of the report. I commend that section of the report and would like to see that in other spaces. So to address the issue of sustainable homeownership, FHFA should do something similar and provide significantly more data transparency about the historical loan performance of different product lines. Again, Home Possible, Home Ready, single family book of business, enterprise housing goals, duty to serve. This information should specifically include the rate at which loans become early payment defaults, if they require buybacks, 3-year default rates, and life of loan default rates for the product line. This simple and basic transparency would allow stakeholders to compare the performance of loans across the overall book of business and those specific product lines to other similarly situated products like FHA, USDA, and VA to gauge whether you're actually succeeding in providing borrowers products that are helping them to succeed. Similar on the transparency piece, recently FHFA, through the Enterprise Housing Goals, ANPR, and actually some of the changes to the PSPAs, identified the potential danger of high-risk loans or loans that have layered risk characteristics. Again, to inform future policymaking, FHFA should publish information on the volume of loans along product lines that have those high-risk characteristics, whether it's duty to serve, enterprise housing goals, the 97 programs, et cetera, et cetera. The level of information would help policymakers and stakeholders like us identify, are these risky loans, whether they are going to actually help promote sustainable home ownership, and whether eliminating them poses fair housing concerns. Last two things. We heard from the enterprises about all these great things they're doing in outreach and education efforts. We heard that from Pam and Katrina, and they really try to go to great lengths to highlight that. It would be so helpful if FHFA, in their reports to Congress, highlighted initiatives that they thought, as regulator and conservator, thought were going to make a difference. And if, frankly, you don't think they're going to make a difference, you should be highlighting that too. Maybe you don't call it out explicitly, but your silence on that would speak volumes too. Lastly, building on what Pam from Freddie Mac mentioned, an item that could make a real difference right now would be for FHFA to shine a light on all of the data it has about the appraisal process and whether it potentially discriminates against borrowers of color. This is something that's really concerning to our members, but FHFA is in a really unique place with its incredible data resources to study whether this is a problem and what can be done about it. And we really would call on the Division of Research and Statistics at FHFA to take this up, to work with industry, to work with the civil rights community, to work with the enterprises, but to lead on this issue. So overall theme that I clearly tried to hit was, please help us shine a light on this racial home ownership and affordable housing gaps. We just can't measure progress without understanding where we are, where we've been, and where we need to go. The steps I've highlighted, again, one of the things I really wanted to do was, you can do this on your own. You don't need anyone's permission. You don't need anyone else to act. You at FHFA can do everything here, and these really would meaningfully address, lay the foundation for succeeding in addressing the racial homeownership gap.
Thank you.
Thanks.
Leslie Gooch from the Manufactured Housing Institute. You're up. And next after that, we'll have Melvin Bailey from MKB Enterprises. Go ahead, Leslie.
Thanks so much, James, and to the team from FHFA and everyone joining today. I would first like to join Matt in congratulating Sandra Thompson in being named as Acting Director of FHFA, and I'd like to congratulate Danielle Walton for being named as Chief of Staff as well. I appreciate the opportunity to share MHI's views about how manufactured housing can help reduce the racial homeownership gap and enable sustainable homeownership. MHI is the only national trade association that represents all segments of the factory-built housing industry. Our members are responsible for close to 85% of the manufactured homes that are produced each year. In 2020, our industry shipped almost 95,000 HUD code homes to create new homeowners across America. The American dream of homeownership remains a leading source of wealth accumulation, which means achieving it can result in a meaningful catalyst toward equality. Addressing systemic barriers to minority homeownership is imperative, and increasing the supply of quality, affordable housing must be an integral part of the effort. This is where manufactured housing comes in. Constructed according to a federal building standard that is administered by HUD to ensure quality and safety, manufactured homes are the most affordable homeownership option available. With the average cost of a new manufactured home at approximately $82,000, it is not uncommon for the purchase of a manufactured home to be less expensive than the option of renting. And unlike other affordable homeownership options, which are often aging housing stock in need of extensive improvements and rehabilitation, a family can attain homeownership in a brand new home that has the latest innovations, energy efficient features, and modern floor plans and amenities. According to a 2020 HUD report, factory-built housing, this is a quote, factory-built housing has undergone many physical changes that have made it more similar to, and in many ways indistinguishable from, conventional site-built housing. Quality improvements in construction and installation practices have increased durability so that the life expectancy of factory-built housing increasingly is comparable to that of site-built or on-site housing, end quote. MHI believes that manufactured housing is a critical part of this discussion and is an important element to increasing the supply of attainable homeownership. In fact, HUD has the statutory duty to facilitate the availability of affordable manufactured homes and to increase home ownership for all Americans. FHFA has a great opportunity to advance racial equity in housing by vigorously enforcing Fannie Mae's and Freddie Mac's statutory responsibility to serve low income and underserved minority borrowers through the duty to serve mandate, which mandates that they serve manufactured housing. MHI has strongly advocated for Fannie and Freddie to meet this statutory duty, not only just for manufactured homes that are titled as real estate, but also for chattel home loans, which is where a consumer owns the home but not the land where it is sited. This is a critically important distinction because chattel loans make up the majority of manufactured housing financing in America. Recently, Fannie and Freddie released their 2022 to 24 proposed duty to serve plans for manufactured housing. We believe that the proposed plans do not adequately address the enterprise's statutory requirement to serve manufactured housing, and we are calling on FHFA to hold the enterprises accountable. Fannie and Freddie need to reaffirm their previous commitment and expand financing for manufactured homes for all qualified consumers, including through support for chattel financing. Exclusionary zoning laws also have an important role in causing racial disparities in the housing market. Restrictive local ordinances, which can include limits or outright prohibitions against manufactured homes, are an important factor impeding the goal of achieving racial equity in homeownership. A 2018 study by the Urban Institute found that, quote, zoning restrictions impede the use of manufactured homes as an affordable housing tool in urban and suburban areas and may help explain why a disproportionate amount of manufactured housing is in rural and unincorporated areas. The Manufactured Housing Improvement Act of 2000 specifically says localities are expressly prohibited from adopting construction and safety standards that deviate from the federal HUD code standards. The statute explicitly states this preemption should be, quote, broadly and liberally construed to avoid disparate local requirements. We believe FHFA must work with and encourage HUD to use its authority to pursue more vigorous enforcement of this provision, which clearly establishes federal supremacy for the construction of manufactured housing. In conclusion, hold on, I just have one sentence. To achieve racial equity, FHFA must take seriously Fannie's and Freddie's statutory requirement to serve manufactured housing. And so thank you. I appreciate you setting this up. I'm sorry I went over a couple minutes, but I really appreciate the opportunity to speak. Thank you.
Leslie. We'll hear next from Melvin Bailey, and after that, we'll take a short break. Melvin?
Yeah, hi. Thank you for giving me this opportunity to speak. I'm calling from the city of Chicago, and I work very closely with housing department in the city of Chicago, and also have worked with FHFA and Community First program. I'm wearing two hats here. I'm an executive director of a non-for-profit with the goal to impede progress and inclusion for the hardest to serve and people who struggle with social profiling. So by that being said, you know, I heard a lot of speeches today, a lot of talk, and it was great. Everyone did a great job. But my main concern is starting from the grassroots community and the grassroots effort. Thank God we're finna build 10 affordable housing in the city of Chicago and the Chicagoland area with the mission. And as soon as we started with this process and went through city council, I got phone calls from potential buyers that wanted to buy from us before we even start breaking ground. And by that being said, I think FHFA need to take that approach of adopting smaller developers. So because we're trying to target the minority and the African-American buyers and borrowers. And a lot of times, as I'm a smaller developer looking at the process, no one looks like me being a developer developing these homes. So that's why I would like to take that approach to talk to FHFA and adopting a program such as ours, because we have some of the finance to get the job done, but we know with a stronger backing from the federal government, we can be successful on building sustainable housing. Just like the young lady just before me, Leslie, started speaking with manufacturing housing. That's a great tool, a great way to start this process. And with the Duty to Serve program, I've been reading so much about this, and it's mind blowing how much FHFA is putting into this effort to make sure that we can move forward. You guys can move forward. But again, I don't see anyone that looks like me, smaller developers, that breaking through that ceiling to say, hey, look, we're taking an organization from the ground level, because reason why we're already have buyers already before we break ground, because we take the bottom up approach, not the top down approach. And a lot of times as we moving forward, trying to do what we're doing, the bigger developers, the bigger banking and financial institution, they take the top down approach and they never reach the bottom. When you take the bottom up approach, there's a different process and a different mindset, because when people look, when you look like a certain individual or come from a certain background or certain community, you get better receptive. People can relate to you more. They cannot relate to the people that sitting high, judging low. So I would like for you guys to really look at that and take that approach so we can move forward. And I would love to send you guys video once we get started so you guys can see how we're building affordable housing in the city of Chicago. And I'm glad that we got the full city council support, the mayor support, knowing that our fight and our mission, because one time the alderman said, Melvin come from protesting developers to becoming a developer, which is true, because we want inclusion. And just like with FHFA, we're saying the same thing. We would love to be included in this process if we're going to be changing lives and making sure that we can show home ownership across the country that's being changed for African-American people. Thank you very much.
Thank you so much, Melvin. We're going to take a 5-minute break. We'll resume at 2 p.m. Eastern with our agenda. And in addition to that, we have a couple of speakers who will be added at the end of the agenda. Maurice Jourdain Earl from Compliance Tech and Elizabeth Laberge from Credit Union National Association. So we'll resume at 2, and our first speaker at 2 will be Monica Bells from National Association of Federally Insured Credit Unions. All right, I see it is 2 p.m. Monica, are you back with us?
Hi, aloha. Yes, I am.
Great. Monica, you're next. And up after that, we'll have Christy Desanctis from the National Association of Realtors. Go ahead, Monica.
Thank you, James. Good afternoon and aloha. My name is Monica Bells. I am the president and CEO of Kauai Government Employees Federal Credit Union. We are a native CDFI, MDI, and a low-income designated financial institution in rural Hawaii. I am here on behalf of NAFCU, the National Association of Federally Insured Credit Unions. NAFCU advocates for all federally insured, not-for-profit credit unions that in turn serve 125 million consumers with personal and small business financial service products. NAFCU members provide access to mortgage credit for many of the nation's minority and underserved communities and stand ready to help their communities in any way possible. In order to continue providing this access and maintain liquidity, credit unions must have unfettered access to the secondary mortgage market using Fannie Mae and Freddie Mac, the government-sponsored enterprises, or GSEs. Credit unions play in the housing market to help consumers, especially low-income borrowers, afford mortgages. NAFCU supports the GSE's role as a market maker in the secondary mortgage market and has previously encouraged the FHFA to consider pilot programs for low or zero down payment mortgage loans that help borrowers build wealth, such as the Wealth Building Home Loan, the WBHL, as developed by the American Enterprise Institute. These types of loans are especially helpful for very low and low income borrowers and should be supported by the FHFA and the GSEs as part of an overall strategy to support affordable, sustainable home ownership. A pilot program would help to develop a secondary market for these types of loans, which would in turn help credit unions make more of these loans to support their communities. NAFCU again reiterates its support for products like this that encourage wealth building among the communities most in need. On Kauai, we have no ethnic majority. The backbone of our community are our local families who run small businesses, work in agriculture, and often hold 2 to 3 jobs in our tourist-dependent economy in order to live paycheck to paycheck. The median single family home price is $1 million. The median income for a single adult in Hawaii is $35,000 a year. The cost of living on Kauai continues to rise due to systemic factors. For example, we import over 80% of our food. Our vulnerable communities they are at a distinct disadvantage and they experience the largest homeownership gaps. They include Native Hawaiians, minority families, single mothers, and our growing low to moderate income households. Financial instability continues to plague our community. NAFCU urges the FHFA to work to develop opportunities to promote affordable housing options and loan structures that can assist in reducing the homeownership gap and help build generational wealth, such as the Wealth Building Home Loan. The FHFA should also encourage the GSEs to offer incentives to lenders to participate in such programs to encourage growth in this market and help to develop a vibrant secondary market for such loans. Furthermore, regulators must ensure that credit unions and community-based financial institutions have access to the secondary mortgage market. An efficient and adequately regulated secondary market is essential to providing affordable mortgages to minority communities. Access to this market is an important, reliable source of capital for lenders and therefore consumers. Without this access, interest rates would be unaffordable for many Americans, including those in low and moderate income communities and areas with little to no access to financial institutions. A poorly functioning secondary market impedes growth in the primary mortgage market and the economy, resulting in a widening disparity between racial and socioeconomic shares in homeownership. Without options for community lenders like credit unions to sell their mortgage loans, to obtain much needed liquidity to continue making loans to their members, the credit union and the communities they serve will suffer. 19% of respondents indicated the expiration of the GSE patch would have a material impact on their credit union. With the impending expiration of the GSE patch on July 1st, 2021, the delay of the mandatory compliance date allows the GSE patch to continue until October 1st, 2022. Amending the PSPAs to allow the GSEs to acquire GSE patch loans until expiration in October 2022 will permit credit unions to better serve more of their members and additional time to adjust the final rule. On Kauai, our CDFI is working tirelessly to help our underserved communities achieve the dream of homeownership.
30 seconds.
We meet with vulnerable and marginalized members of our community every day, many who feel hopeless. We need help to close the homeownership gap among these communities. In closing, NAFCU and the credit union community support affordable housing and increasing homeownership among minority and low to moderate income communities. We look forward to working with the FHFA and the GSEs to help all members of our community thrive and achieve homeownership. I thank you for your time today and the opportunity to present on behalf of NAFCU.
Thank you, Monica. Next, we'll hear from Christy Desanctis from the National Association of Realtors, and after that, David Sanchez from the National Community Stabilization Trust. Go ahead, Christy.
Great, thank you all for having today's listening session, and congratulations again to Acting Director Thompson on the recent appointment. The National Association of Realtors is America's largest trade association, representing nearly 1.5 million realtors in all aspects of the residential and commercial real estate industries. Members are committed to the development and preservation of the nation's housing stock, along with its availability to the widest range of potential home buyers. We are acutely aware of the racial homeownership gap and the need to address these outstanding issues to promote sustainable homeownership. So we greatly appreciate today's event and the ability to provide brief remarks. I'm going to speak high level on a number of questions posed and look forward to following up with the FHFA team following this event. Earlier this year, NAR partnered with leading experts at the National Community Stabilization Trust and the National Fair Housing Alliance that you'll also hear from today, where we specifically focused on how we can preserve homeownership from the impact of the pandemic. This research was done to examine what we learned from the past following the Great Recession that we know disproportionately affected communities of color, and how we can ensure that post-pandemic measures do not further damage homeownership opportunities. To this end, we know that the GSEs must be very careful in treating distressed borrowers as the pandemic wanes, especially as underserved communities have borne the brunt of this pandemic. Every effort should be made to support continued ownership, and if that's not workable, the GSEs, in conjunction with servicers, should act as neutral guide in recommending sales with equity or short sales. We know the CFPB has been active on this space, and we've been vocal on our support for consumer protections to help with post-forbearance options there as well. Every effort should be made to avoid foreclosure and its damaging short-term and long-term effects on households, as well as their equity and credit. Preventing unnecessary foreclosures and home loss will further ensure that vacant properties are not negatively impacting communities. And by leveling the playing field for owner-occupants to purchase homes, we can prevent this health crisis from undermining racial equity in housing markets. NAR continues to study the homeownership gap and the characteristics of sustainable homeownership, and we hope you will continue to look to us as a resource on this matter. For example, according to our 2019 profile of homebuyer and sellers, Black homebuyers were 2.5 times more likely to be denied a mortgage than white borrowers at 10%, whereas 6% of Hispanic homebuyers were denied mortgages, compared with about 4% of white and Asian applicants. NAR's 2021 snapshot of race and home buying examined the homeownership rate among each race and found numerous barriers for Black and Hispanic Americans to save for a down payment in attempting to qualify for mortgage credit, such as differences in the ability to use the funds from the sale of our primary residence, to tap into 401k funds, and the impact of student loan debt, to name a few. This research informs the path to achieving sustainable homeownership while also helping policymakers to target resources and reforms to promote workable solutions on federal, state, and local levels. We're always happy to share this information to inform on homeownership priorities, including other recent policy research we have on alternative credit scoring and housing as infrastructure and contributing to the economic recovery. In terms of specific actions Fannie, Freddie, and FHA too could take to help reach underserved communities, NAR has been advocating for a number of changes over the years, including FHA premium reductions and elimination of life of loan premium. Additionally, given America's increasingly older housing supply with underserved communities and borrowers of color often living in areas with older homes, the GSEs and FHA can work to improve rehab and rental loan products to better serve those potential borrowers, such as increasing limits on total cost and reducing restrictions on usage. Conventional and FHA loan products should continue to operate in a complementary way to improve outcomes for those historically underserved by the conventional mortgage market. And the GSEs must strike a balance between their charter role to support a national market to provide counter-cyclical support and to serve underserved communities, while also serving as an innovator in the underserved space, developing products, methods, and investor bases that may remain untapped. To this end, NAR has been advocating for more direct steps to canonize the GSE's role as financial market utilities, as the most effective and least disruptive way to lock in their critical role in the market. By minimizing the cost to consumers in normal and stress periods, the GSEs estimates will maximize access for creditworthy borrowers while utilizing private capital to protect taxpayers and private ownership, optimize innovation in a sustainable mission-driven structure. Lastly, loan level pricing adjustments for owner occupants are already addressed as insurers in the primary market include risk in the cost of mortgage, and the GSEs can capitalize for this risk without pricing it. And worst of all, we know LLPAs push the burden on those who can least afford it. So in closing, I'd like to thank you all again for this opportunity, and we look forward to working with you on these efforts. Thanks.
Thank you so much, Christy. Now we're going to hear from David Sanchez at the National Community Stabilization Trust. Following that is Garth Bremen from the National Council of State Housing Agencies. David?
Thanks, James. Thanks for the opportunity to speak today, and it's great to be here among so many friends and former colleagues. My name is David Sanchez, and I'm the Director of Research and Development at the National Community Stabilization Trust, which is a national nonprofit that supports families and communities by restoring distressed single-family homes, strengthening neighborhoods, and increasing sustainable, affordable homeownership. We do this by facilitating sales of distressed homes to community-based buyers, such as the Melvin's organization, by providing technical assistance and capital for single-family rehab, and by conducting federal policy advocacy that is grounded in our knowledge of distressed housing markets. Before I begin, like others, I'd be remiss if I did not congratulate Acting Director Thompson, who I know has the knowledge, leadership skills, and courage necessary to lead FHFA. Today's topic of closing the gap to sustainable homeownership is a critical one, and it's one where FHFA and the GSEs have a tremendous ability to lead if they choose to. We hope today's listening session is the first step towards a much greater emphasis on questions of access and affordability at FHFA and both GSEs. Today, I will make 7 recommendations that would help close the gap to sustainable homeownership. My first 3 recommendations discuss ways that the GSEs can increase the supply of affordable homes, which, as others have referenced, is a topic that must be central to any discussion of sustainable homeownership today. The remaining recommendations touch on loss mitigation, credit policy, and the GSE's affordable housing obligations. First, we urge FHFA to remember the importance of property disposition policies and programs to the supply of affordable homes and to the stability of communities. Under FHA's Neighborhood Stabilization Initiative, each GSE makes REO properties available to community-based nonprofits and others for an exclusive purchase opportunity, or what we call a first look. NCST is grateful for Freddie Mac's partnership in implementing this program. Fannie Mae sells its REO properties through its Community First platform, and we urge FHFA to closely monitor the effectiveness of Fannie Mae's policies and practices in this space. Additionally, given the extreme shortage in affordable inventory for homeownership, we urge FHFA to reconsider the GSE's note sale programs to ensure that the properties backing these loans continue to be available for owner occupancy. Second, we urge FHFA to allow the enterprises to make equity or equity-like investments that support their affordable housing mission. This could include not only investments in high-capacity CDFIs, as discussed by my colleague Chris Zieglin and Mike Lofton, but also in particular transactions that support the production or preservation of affordable housing. Such investments would meet a clearly documented shortage of equity capital that supports these affordable housing activities. While certain limits on the GSE's investment authorities may be prudent, we encourage FHFA to be transparent about any limitations it places on these activities. Third, we recommend that both GSEs consider new initiatives to purchase construction to permanent mortgages, both for single family and multifamily properties. Purchasing these loans on competitive terms is one clear way that the enterprises can directly increase the supply of new homes. Fourth, we encourage FHFA and the GSEs to ensure that their loss mitigation programs are as effective as possible in preventing unnecessary foreclosures. One critical step is allowing all borrowers to be eligible for an interest rate reduction as part of a flex modification, including those that have significant equity in their properties. In addition, the GSE should allow escrow shortages to be deferred through payment deferrals and to be included in flex mods. The CFPB's mortgage servicing rule released just yesterday clarified that this was permissible under RESPA. Fifth, we encourage FHFA and the GSEs to offer a true streamlined refinance program for low wealth borrowers. If the obstacle to such a program is the expiration of the GSE patch tomorrow, we urge FHFA to extend this patch for this purpose until that authority expires next October under CFPB rules. Sixth, We encourage FHFA to reduce or eliminate loan level pricing adjustments, or LLPAs, which charge additional fees to low-wealth borrowers and those with less pristine credit. These fees not only drive up the cost of home ownership for these borrowers who are disproportionately borrowers of color, but also directly limit the GSE's ability to serve these borrowers by making GSE financing less attractive than FHA-backed mortgages. FHFA should also consider its adverse market refinance fee and the unnecessarily large capital buffers in its 2020 capital rule, both of which unnecessarily increase the cost of credit. Seventh and finally, I'm sorry if I'm going over a second, we encourage FHFA to consider how to incorporate racial equity into the duty to serve program and the affordable housing goals. In the case of duty to serve, while the existing rules extra credit for residential economic diversity is well intentioned, it is clear that more is needed. Additionally, federal law includes a provision where the FHFA director may recommend to Congress additional underserved markets to which duty to serve should apply, which could be one way to incorporate racial equity more firmly in the program. In the case of the goals, FHFA should consider whether to create sub-goals based on race or ethnicity, since the geographically based goals regime does not seem to be producing the results it should. Thank you again for the opportunity to speak today.
Thank you, David. 7 recommendations in under 5 minutes. Well done. Next, we'll hear from Garth Riemann, and following that, we have Maureen Yap from the National Fair Housing Alliance. Garth?
Thank you very much. Differential home ownership rates, wealth, and access to credit and other opportunities among majority and minority members of our society and their communities are serious problems that are deservedly attracting significantly more attention and focus lately. NCSHA shares these concerns and supports concerted efforts to address them. We applaud FHFA's interest in these problems and urge it to intensify its efforts to ameliorate these gaps and direct the GSEs it regulates to increase their impact in this area. One of the most important ways FHFA and the GSEs can support minority home buyers is by helping them clear the down payment hurdle. Saving up for a down payment or otherwise accessing down payment funds is perhaps the primary barrier to affordable home ownership for low and moderate income families and racial and ethnic minorities. The GSEs can address this problem in at least 3 major ways: supporting safe and sustainable high loan-to-value ratio lending, working with trusted partners specializing in providing down payment assistance, and providing liquidity for secondary financing. FHFA and the GSEs should improve pricing and remove underwriting and purchase volume caps on high LTV lending provided by state housing finance agencies and other mission-oriented lenders. HFAs have a proven track record in safe and sustainable lending to minority home buyers through low interest financing, flexible but reasonable underwriting, down payment assistance, home buyer education, and conscientious loan servicing. Fannie Mae and Freddie Mac should restore the advantageous terms and pricing they offered in the past for moderate income borrowers using HFA loans, and should develop new and even more supportive policies for HFA lending. Restoring the preferred product benefits would be especially impactful for moderate and middle income minority households who often don't have the same access as others to financial assistance from family or other resources to help pay for a down payment. FHFA should also work with the Treasury Department to reverse the provision of the GSE's preferred stock purchase agreements that limits the purchases of supposedly high-risk loans. The characteristics this provision targets, LTVs over 90%, DTIs over 45%, and FICO scores below 680, are exactly those flexibilities necessary to serve people of color and their communities. Other policy changes we recommend to promote greater home ownership for people of color include: revise the GSE's automated underwriting systems to eliminate the ways in which they downgrade HFA loans with down payment assistance by apparently requiring borrowers to have unnecessarily high credit scores. Unlock access to credit for thin credit file and other borrowers without high credit scores by leaning into credit scoring, building, and reporting alternatives. Increase liquidity for home improvement and energy efficiency financing to address the growing needs of our old and aging housing stock. This is a particular concern for many people and communities of color. Authorize and direct the GSEs to support HFA lending programs by purchasing their tax-exempt bonds. Update the enterprise's duty to serve obligations and affordable housing goals to push them to make a bigger difference for people and communities of color. Pursue multifamily lending, duty to serve, and affordable housing goal initiatives that reduce renter housing costs, including significantly greater housing credit investments and tax-exempt bond purchases. These steps will improve lower-income renters' ability to cover other basic living expenses, save for home ownership, and achieve stability and self-sufficiency. Thank you for the opportunity to testify today. I'm now finished.
Thank you, Garth. Next up, we have Maureen Yap from the National Fair Housing Alliance, followed by David Workin from the National Housing Conference. Maureen?
Great. Thank you, James. Thanks, everyone. My name is Maureen Yap, and I'm a senior counsel with the National Fair Housing Alliance. I'm sorry. So we see a number of issues in terms of barriers to home ownership for people of color. So namely in terms of collateral, DTI, and insufficient credit. So with respect to collateral, we hear problems about the home not being appraised to match the contract price. We also hear a lot about homes in disrepair. So a couple of causal factors here. One can be appraisal bias. That is where a similarly situated home in a Black neighborhood is vastly undervalued compared to a similarly situated home in a white neighborhood. We also see problems with discrimination in REO maintenance and marketing and disinvestment in communities of color. So a few recommendations here. One is updating the appraisal guidelines. So of course the GSEs have a lot of influence over what appraisers can do. So we strongly urge FHFA and the GSEs to take a hard look at the guidelines. We know that the sales comp method is the preferred method at this time. It's highly favored, but we have concerns that this method tends to embed, amplify, and perpetuate discrimination that began as early as the 1930s HOLC maps. So we strongly urge FHFA and the GSEs to update the appraisal guidelines. Next, we also strongly urge support for the Neighborhood Homes Investment Act. This is now part of President Biden's American Jobs Plan and has bipartisan support. It would allow federal income tax credits for home rehab, and it's estimated that it could build and rehab 500,000 homes for LMI homeowners over the next decade. We also recommend improvements to the renovation mortgage products. These are good products, but they could be more user-friendly for borrowers. We hear that one of the key problems is that borrowers don't know who a trustworthy contractor is. This may sound like an insurmountable problem, but we urge FHFA and the GSEs to look at the insurance model, where insurance companies actually provide a list of trustworthy contractors and monitor their work. The other big barrier to home ownership has to do with DTI, which is also related to loan to value. And two problems there have to do with down payment and expensive and unfair LLPAs. So with respect to down payment, we strongly urge support for the Center for Responsible Lending and NAFA Down Payment Assistance Program. And here we're recommending a framework of assistance for first generation home buyers with income within 120% of AMI. We believe the eligible pool would be about 12.2 million families, with about 72% being families of color. We also recommend the DOJ and HUD study whether more specific race-conscious remedies are needed. And this would be under the framework of socially and economically disadvantaged individuals. We would recommend a rebuttable presumption for people of color as being within the category of socially and economically disadvantaged. We also recommend a hard look at LLPAs. These were put in place during the foreclosure crisis, And we believe that they have an unfair and discriminatory effect on borrowers and communities of color. So a number of us have talked about the struggles with down payment. And of course, under the LLPA matrix, the lower the down payment, the more you pay. This, of course, can drive up the DTI, drive up the price, and may ultimately make the mortgage unattainable. So we think it's time to review and potentially eliminate the LLPAs. Last, there's the barrier of insufficient credit. And here the problem is that credit scoring in many ways embeds and reflects discriminatory patterns. So for example, a borrower of color's credit score may be penalized for accessing non-traditional credit, such as payday loans, but that may be due to living in a credit desert as opposed to credit worthiness. So we strongly recommend that FHFA and the GSEs create purchase programs for special purpose credit programs. This program has long been on the books for Reg B, but we need operational manuals, guidance, and an assurance to lenders that there is liquidity in the market for the purchase of these programs. Thank you again for your time, and we applaud FHFA for hosting this listening session today. Thank you.
Thank you, Maureen. Next up, we have David Workin from the National Housing Conference, followed by Corey Harris from Neighborhood Housing and Development Corporation. David?
Thank you, James, and thank you, Acting Director Thompson. I look forward to working with you and your team. The National Housing Conference is the oldest and broadest housing coalition in the United States. NHC was founded in 1931 by Mary Kingsbury Simkovich and Helen Alfred as an unlikely coalition of social workers, religious leaders, builders, and labor unions. Together, we have experienced every housing crisis of the past 90 years. Today, NHC has led a broad coalition to fund $10 billion for the Housing Assistance Fund. And on the first Juneteenth federal holiday, announced a plan by the Black Homeownership Collaborative to sustainably create 3 million net new Black homeowners by 2030. This 3x30 initiative was led by a steering committee consisting of NHC, the NAACP, the Urban League, the MBA, the National Association of Realtors, NAREB, the National Fair Housing Alliance, and with research from the Urban Institute. We continue to work together to meet this daunting but essential objective. We believe that if the right changes are made, which are addressed in our 7-point plan and corresponding workstream recommendations, this goal can be met. But it cannot succeed without serious and sustained participation of Fannie Mae and Freddie Mac. With new leadership at FHFA, we are hopeful that the enterprises will play a major role along with other members of the collaborative to help us meet this audacious objective that would sustainably push the Black homeownership rate to well over 50%. This would be an historic accomplishment, but still leave much work to be done to close an unacceptable gap in homeownership for all people of color. Yet, FHFA policies have contributed to increasing the cost of homeownership by restricting the availability of mortgage credit when it needed to be expanded, widening the racial homeownership gap as a result. The stated intent of FHFA has been to increase the capital of the enterprises to prepare for a release from conservatorship. However, this objective has been rushed by insisting on increases in capital inconsistent with the enterprise's mission of providing liquidity to underserved markets. An arbitrary restriction on mortgage lending pilots essential to the enterprises responding to lender efforts to responsibly increase homeownership and refinance origination and engagement policies that have hamstrung the enterprises. NHC recommends that the new leadership of FHFA pursue several significant changes in these policies that can contribute to sustainable increases in homeownership, especially among people of color who have been disproportionately harmed by the relative absence of the enterprises from these markets. First, we must end loan level price adjustments that target first-time and first-generation homebuyers. Second, the PSPAs must be revised to eliminate the cap on so-called high-risk loans. This restriction is unnecessary, unwarranted, and extremely damaging to those who need access to enterprise mortgages. Third, FHFA must immediately repeal its ban on product pilots. Product pilots are essential to ensuring that the best ideas developed by lenders across the country are tested and scaled. Unsuccessful pilots are an essential part of the innovation process, and successful ones are critical to the enterprise's mission to add liquidity. Fourth, both Fannie Mae and Freddie Mac need to work with lenders to create mortgage products that encourage lending for small dollar mortgages. This should be a high-level priority as part of a renewal of pilot programs. And fifth, the enterprises must work with lenders to develop special purpose credit programs that directly target underserved borrowers. I am happy to further engage with the FHFA leadership team on any and all of these issues. Thank you for this opportunity.
Thank you very much, David. Next up, we have Corey Harris from Neighborhood Housing and Development Corporation, followed by Susan Stewart from SWBC Mortgage, representing Mortgage Bankers Association. Corey?
Thank you. Thank you for this opportunity. I appreciate this opportunity to share during this FHFA listening session. Again, my name is Corey Harris with Neighborhood Housing and Development Corporation, where we provide housing solutions for low and moderate income families through a number of programs. Our housing development activities, our financial literacy, financial capabilities, our home buyer education, owner-occupied rehab. We do some rental housing as well. Before I move forward, I want to congratulate Acting Director Thompson. Look forward to working with you and engaging with you. What we see are several critical areas that should be addressed. Education is one. Many of the families that reach out to us lack the financial education. Oftentimes we'll hear people say that, I wish this stuff was taught in schools, but unfortunately it's not. And so education around home ownership and the opportunity to own a home and sustain a home is definitely missing in our society. And so we would like to see more programs geared towards funding educational programs. Along those same lines, we want to see where there's more education around reducing mortgage scams. We noticed that a lot of our families that we serve, one of the services that we provide is foreclosure intervention. And they're being bombarded with all of these, people that are companies that have these, what would be deemed as official letterheads saying that they can provide mortgage relief. And oftentimes we're seeing that these people are succumbing to these scams due to lack of education. So we would like to see where there's more resources devoted to that. One person talked about building capacity. A lot of these various programs require a more level of sophistication or professionalism. And, there are some smaller organizations and smaller developers that could use assistance with that capacity building to be able to use that instead of top-down approach that moving up the ladder and meeting those people right where they are. And that community engagement piece, we feel like that's ultra critical as well. Oftentimes we see where we'll have developers that will go into some of our tough communities, and instead of engaging the residents, they go in and try to tell the residents what they need. And so we want to see more programs geared towards that community engagement piece as well. Before I close, the expanding the mortgage products. I've heard many people talk about, being able to offer various mortgage products. And the very last thing is more DPA, more down payment assistance. It's ultra critical. It's a way of kind of shared equity piece when, government and funding can be used to help people eliminate the barrier of home ownership or achieving home ownership by helping to reduce the upfront cost of home ownership. So again, thank you guys for this time. I definitely appreciate it.
Thank you so much, Corey. Susan, you're up next, and following Susan, we'll have Jung Choi from the Urban Institute. Susan? You're on mute, Susan.
Hi, my name is Susan Stewart. As mentioned, I'm the CEO of SWBC Mortgage and I'm chairman of the MBA, representing that group today. And we appreciate the opportunity to discuss our perspective on addressing the home ownership gap. And we'd like to recommend some areas that FHFA and the GSEs might consider for future action. The MBA is dedicated to helping address the nation's affordable housing challenges and seeking possible solutions through the creation and expansion of initiatives targeted at affordable housing production, access to credit for minority consumers, and diversity, equity, and inclusion in the mortgage industry. In an effort to address this crucial issue, MBA has recently formed a task force on building minority home ownership, established 2 advisory councils, one on affordable home ownership and one on rental housing, launched 2 place-based initiatives, Convergence Memphis and Convergence Columbus, focused on moving the needle on minority home ownership and expanding and strengthening our diversity, equity, inclusion efforts. I'm going to join the great chorus of my peers today and ask for make some recommendations from the MBA to FHA for consideration. As role and regulator and conservator of Fannie Mae and Freddie Mac, as well as regulator of the Federal Home Loan Banks, FHFA has a great opportunity to put in place policies that directly and indirectly narrow the homeownership gap. We ask that FHFA consider the following recommendations, which we believe could help address obstacles to minority home ownership and help close the homeownership gap. We'd like to recommend the increase the income limits for Fannie Mae, Home Ready, and Freddie Mac Home Possible programs above 80% AMI, particularly in high-cost markets. We'd like to ask for consideration to lower or remove unnecessary GSE LLPAs and delivery fees on rate term refinances that lower monthly payments for consumers that have not accessed today's historically low rates. We'd like to recommend and ask that FHA consider further enabling borrowers to access the historically low rates through actions such as eliminating the adverse market refinance fee or clarifying that missed payments due to COVID-19 forbearance does not qualify home buyers from access to the Refi Now and Refi Possible offerings. We'd like to ask for recommendation to consider reverse certain pricing adjustments based on credit scores for low down payment products in targeted geographic areas, explore new credit assessment tools for underscored and thin file borrowers. We'd like to ask to exclude the mortgage insurance cost from the 3% cap on points and fees, which would have multiple positive effects. Maintain and strengthen the current duty to serve structure while also improving on its foundation over the next few years by directing the GSEs to examine new ways to help underserved communities in difficult to reach markets. FHFA could, for example, explore a racial equity obligation or benchmark under the duty to serve rubric, expand secondary marketing pools and programs that would benefit minority borrowers and communities, reassess certain elements of the enterprise regulatory capital framework to determine whether the structure of the finalized rule will inhibit access to credit for minority borrowers, and work with the Treasury Department to remove limits on the revised senior preferred stock purchase agreement that target risk-layered loans, as these limits are likely to disproportionately curtail lending to minority borrowers. These policy changes will help ensure that FHFA's regulated entities are doing everything within their charters and mandates to provide for a more equitable system of housing finance. Thank you very much for the opportunity to speak today and to provide these observations and recommendations.
Thank you so much, Susan. So next up, we have Jung Choi from the Urban Institute. And following that, we'll hear from Maurice Jourdain Earl from Compliance Tech. Go ahead.
Great. Thank you, James, and thank you for providing me an opportunity to speak today. In this presentation, I will talk about what we have learned from our research, where we need more data, and conclude with some policy suggestions. So I will focus on Black households who have the lowest homeownership rate and have been most impacted by the Great Recession. So if we do not take serious action soon, our research projects that the Black homeownership rate will further drop in the next 20 years, and the Black-white homeownership gap will continue to grow. There are also stark racial disparities in the US, which are highly correlated with the homeownership differences. Homeownership plays a big role in creating wealth for Black families. Black homeowners have about 60% of the wealth in their home equity. Black homeowners are most likely to be denied from receiving a mortgage. Our analysis of 2020 HMDA data finds that mortgage denial rate for Black home buyers was over 24%, more than double that of white and Asian home buyers. Credit history was the top reason for denial, followed by the DTI ratio. Even after obtaining homeownership, Black households face greater challenges to build wealth. Due to lower income, less wealth, and less family support, Black home buyers have a higher LTV at mortgage origination. This increases the time to pay off their mortgage debt and also increases the likelihood of default. Black households also pay relatively higher user costs, which includes interest and property tax payment, as well as maintenance costs. Our research shows that Black homeowners are more likely to switch from owning to renting. We also find that the Black-white interest gap increases after mortgage origination. This is because Black homeowners are less likely to refinance. In the 2020 HMDA data, the share of refinance loans were significantly lower for Black and Hispanic homeowners compared to white and Asian homeowners. The data also shows that Black homeowners were most likely to experience denial for refinancing. The recent Fed study finds that households saved about $5.3 billion from refinancing during the first 10 months in 2020. However, less than $200 million, or 3.7% of the total saving, went to Black households. Again, credit history was the most frequently mentioned reason for denying mortgage refinancing for Black households, followed by the DTI ratio. Credit has become tighter during the COVID pandemic, and the share of refinancing loans with lower FICO score has dropped substantially. As the HMDA data shows, credit is the biggest reason for Black households to be denied from getting a mortgage and refinancing. While more research is needed, the current publicly available HMDA data do not release credit scores. Having access to this data would be very valuable for research on the racial homeownership gap. Additionally, very few large data sets, except for the NMDB, provide both outstanding mortgage debt and home prices, which enables us to accurately calculate the level and the changes in home equity over time. Moreover, the NMDB includes many important variables such as current interest rate, delinquency, forbearance, and refinancing activities. To examine how households of color build wealth and sustain homeownership, having easier access to this data would be extremely useful. As many mentioned, there is no single policy to solve the racial homeownership gap. Here, I like to mention 3 areas where the FHFA can make an impact. The first is to include rental payment history in the underwriting process. Households of color are more likely to have missing credit scores, so including this information could help to access homeownership. The GSCs are currently working on developing a program in this space, and we hope that the FHFA will facilitate the approval process. The second is streamlining and designing a well-targeted down payment program. There are numerous down payment programs across the nations, and many are unknown or underutilized. Improving the clarity and the simplicity of these programs could help households of color to access homeownership and lower their overall mortgage cost. Our recent research also finds that targeting first-generation home buyers can be especially beneficial to Black and Hispanic families. Finally, we propose a more streamlined refi program. This can lower the default rate of households of color, which promotes their housing sustainability and also help them to build wealth. Thank you.
Thank you so much. So next we'll hear from Maurice Jourdain Earl from Compliance Tech, followed by Elizabeth Laberge from Credit Union National Association. Maurice?
Okay, I don't know whether I'm being heard yet. Can you hear me, James?
Yes, we can hear you.
Okay, very good. I'm gonna make this short and sweet if I can. I think everybody is going nuts when it comes to dealing with the issues of Fannie and Freddie. Sandra, you know I've been at this for a long time. One, I congratulate you for moving up to becoming the acting, and I hope you become the actual director. Fannie and Freddie's been a problem for a long time. Average share of loans that they've bought from lenders over the last 17 years is 3.98%. The top 10 lenders that sell loans to Fannie and Freddie account for 39%. Top 50, 56%. Problem is Fannie and Freddie, and I will say Federal Housing Finance Agency, has been enabling these lenders by continuing to buy loans from them. Fannie and Freddie do not make loans, lenders do. Until Federal Housing Finance Agency and Fannie and Freddie cut off those lenders that are not originating loans to people of color, Black people in particular, because the numbers are awful. And I'm saying, particularly for those that are originating loans that are for sale to Fannie and Freddie, they are not making the kind of loans that Fannie and Freddie buy, largely because Fannie and Freddie's underwriting and pricing guidelines just do not fit. And so any of the things that have happened in the past with regards to helping people of color, Black people to buy homes under those guidelines have not worked because they've not been designed to work. Those that have been created like Home Ready and Home Possible, yes, they sound good on paper. A lot of money has been spent to promote them, but the reality is they have not been originated simply because the pricing does not fit the target market. To that degree, I say that if you have an average FICO score that's needed to be 700 plus, you might have 3% down, but yet your credit score is not there. Furthermore, the private mortgage insurance make those loans unaffordable to any of the people, which is why those loans are not on Fannie and Freddie's books. I get back to the average share of loans bought by Fannie and Freddie over the last 17 years at 3.8%, 3.9% rather. They've never bought loans from people of color. They've never bought loans from Black people of any size. To that degree, any of the loan modification programs, rescue programs, this new refi program that's being touted, HARP, HAMP, it is in effect been white affirmative action, simply because the majority of loans that have been bought by those agencies have been middle and upper income white people in middle and upper end white neighborhoods, pure and simple. So until we come to grips with the fact that the lenders are really at fault and that the government is enabling these lenders to continue to do what they do, we will never get out of this demise. When the top 10 lenders originate 39% of the loans that Fannie and Freddie buy, the top 50 do 56%. If you cut them off and stop enabling them, they will find a way, because they're in it to make money. They will find a way to serve all Americans. And so it's a simple solution. Let the lenders come up with these solutions. They're the one that's making all the profits and we the government, and I say we, the stockholders. I've been a stockholder since 2008, and I've held on to it for a purpose, to see how bad it can get with regards to being a stockholder who's covering the cost of keeping these nationalized institutions alive, because we as stockholders are not receiving any dividends or any profits. So it is a simple solution. Cut off those lenders from and stop buying loans from them. And they got to do it together. When I put this to Fannie and Freddie, Fannie says we can't stop doing it because Freddie will continue. It's got to be dual. And that means it has to be a solution that comes from the Federal Housing Finance Agency as their regulator. So James, I want you to cut me off because I can keep going in terms of
15 seconds.
15 seconds, then I will stop right here. The simple solution, cut them off. They will come up with a solution because they want to make money. End of story. Thank you.
Thank you, Maurice. Short and sweet. Elizabeth Laberge, you're going to be our final speaker, and then I'll give some closing remarks.
Thank you, James. My name is Elizabeth Laberge, and I am Senior Director of Regulatory Advocacy and Counsel at CUNA. CUNA represents America's credit unions and their more than 120 million members. And on behalf of those credit unions and their members, I'd like to thank the FHFA for holding this listening session. And we'd also like to extend our congratulations to Sandra Thompson for elevation to Acting Director and Danielle Welton for elevation to Chief of Staff. Congratulations, ladies. The racial wealth gap and the racial homeownership gap both persist in lockstep, mutually reinforcing one another. Obviously, this is a large systemic problem. My remarks will focus on a few specific issues where we believe the FHFA could affect change through policies of the GSEs. First, credit unions are very disturbed by the increase in complaints of racial discrimination by appraisers reported by HUD. Undervaluation of homes owned by people of color exacerbates the homeownership gap and the racial wealth gap and negatively impacts minority depository credit unions and other credit unions that serve Black Americans and other Americans of color. It further discredits the reliability and the value of home appraisals generally. Credit unions rely on appraisers for accurate and unbiased opinions of the market values of the homes that serve as collateral for their mortgage loans. When racial prejudice is injected into that process, it prevents credit unions from meeting their mission to serve their members, and it introduces unnecessary risk into the housing finance system. CUNA applauds President Biden's recent creation of a task force to address this issue and is grateful that the FHFA is serving on that task force. CUNA also supports the FHFA's recent effort to assess and modernize the current GSE's appraisal policies, practices, and processes. And we've strongly encouraged the FHFA to carefully examine the education and training requirements for appraisers to ensure they not only understand their existing obligations under the Fair Housing Act, but that they also receive training on implicit and unconscious bias to ensure appraisers have the tools needed to consciously confront their own bias so that it does not appear in an appraisal report. Further, CUNA strongly supports efforts to improve the number and diversity of appraisers. The pipeline initiative Fannie Mae is engaging in is very exciting, and we hope for its success. Appraisers have been in short supply for some time, and increasing the number and diversity of qualified working appraisers will improve equity for home buyers across the country, not only in the quality and accuracy of appraisals, but also in the speed of the appraisal process and subsequent closing as well. In the course of operation, this task force, CUNA hopes that participants will consider the increased use of technology and data to conduct valuations, which would greatly benefit consumers and reduce reliance on subjective judgments by individuals. In particular, the secondary market's dedication to an antiquated model of in-person appraisals will likely help perpetuate the appraisal industry's inefficient and disadvantageous approach to the detriment of people of color, people in rural areas, and low and moderate income consumers. Focusing on permitting greater use of artificial intelligence, virtual video communications, and other technologies could make appraisals less costly, timelier, and more equitable for all. Secondly, the FHFA should consider a pilot program for the acceptance of small mortgage loans underwritten with alternative credit data in lieu of traditional credit scores. Credit unions play an important role in meeting the needs of members with distressed, thin, or invisible credit. The unique structure of credit unions and their close relationship with members allows them to be more flexible than other financial service providers when finding ways to meet consumers' needs and to provide credit. Many credit unions already adapt their operations to fit the unique needs of credit distressed or credit invisible members, such as offering non-traditional products and services to help build credit, to access home ownership, and credit unions also provide financial literacy education. Credit union underwriters use tools beyond the credit report to understand a consumer's financial situation, such as reviewing an account to establish consistent income or their history of timely rent and utility payments. Credit unions support the use of alternative data to find solutions to meet these needs, and an FHFA pilot program could work with lenders to understand and evaluate these alternative data underwriting practices to help establish an appropriate risk assessment for these types of programs and to create additional routes for selling these kinds of loans into the secondary market. Creating liquidity for these small mortgages may take additional effort, but these are critical to closing the home ownership gap. Finally, I'd like to reiterate CUNA's passion to the threshold in the enterprise's home affordable lending products. As we previously stated, this income limitation often fails to accurately capture the economic realities of some geographical areas or neighborhoods within a metropolitan statistical area. In high-cost areas, the AMI can be driven upwards by high earners in particular neighborhoods, and reliance on the AMI ultimately makes these products ineffective to help borrowers seeking to purchase a home at current market prices. We'd strongly urge the FHFA to consider alternatives to qualify borrowers for these programs and to better facilitate borrowers purchasing homes at current inventory prices. Thank you for holding this listening session today, and CUNA stands ready to provide any further information that might assist the FHFA as it considers these important issues. Thank you.
Thank you, Elizabeth, and thank you to all of our speakers today and to Director Thompson for her remarks. Confronting the racial homeownership gap is essential to closing the racial wealth gap. FHFA plays an important role in the oversight of the housing finance system. Public feedback like we received today is essential to informing how FHFA exercises that role. We hope that today will be the beginning of an ongoing dialogue with stakeholders on these important issues. As I mentioned, you will be able to find a recording and a transcript of this session on FHFA's website in the future. Speakers, if you did not get a chance to submit slides before this session, please do so to the email address coordinating this session, and we will include those along with a transcript of your remarks. Again, thank you very much for your time and thoughtful remarks today. This concludes our listening session for the day.